Hello everyone! Today, let's talk about a common technical pattern in the stock market, rectangle pattern. This pattern typically appears after a strong upward or downward movement, followed by a period of sideways consolidation. It is an important technical signal that helps us predict the potential breakout direction of the stock price. What is the rectangle pattern? The rectangle pattern is formed when the stock price fluctuates within a narrow range, creating clear support and resistance lines. The price repeatedly moves within this range, but it struggles to break through the upper and lower boundaries. There are two main types of rectangle patterns. Rectangle after an uptrend. After a strong rise, the stock enters a sideways consolidation phase. This usually signals that the stock is likely to continue its upward trend. Once the price breaks above the upper boundary, a new upward movement may begin. Rectangle after a downtrend. After a decline, the stock enters a sideways consolidation phase. This typically indicates that the stock might continue to drop. Once the price falls below the lower boundary, a new downward trend could be triggered. Example. Let's take a look at a stock that has strongly risen over the past few months from $40 to $60. After this rally, the stock enters a sideways consolidation phase, with the price fluctuating between $55 and $60, forming a clear rectangle pattern. Every time the stock approaches $60, it faces selling pressure and drops back to around $55, then rebounds. This repeated oscillation within this range shows that the buying and selling forces in the market are balanced, and the stock is unable to break through the upper or lower boundaries. After a few days, the stock breaks above the $60 resistance level, accompanied by increased volume, confirming the breakout signal. At this point, investors can buy on the breakout and take advantage of the upward movement. The price then rises to $65, further confirming the continuation of the uptrend. How to use the rectangle pattern. Confirm the consolidation range. First, observe if the stock price is consolidating within a relatively fixed range, forming clear support and resistance levels. This range could be horizontal or slanted. Wait for the breakout. When the stock price breaks above the upper boundary for an upward consolidation, or falls below the lower boundary for a downward consolidation, it usually signals that the trend might continue. Pay attention to volume changes when the breakout happens. Increased volume adds credibility to the breakout. Set stop loss. If you decide to enter a position after the breakout, you can set your stop loss just below the support level for upward consolidations, or just above the resistance level for downward consolidations. This will help protect you in case of a false breakout. Target price. The target price for a rectangle pattern can typically be predicted by measuring the height of the consolidation range. For example, if the stock has been oscillating between $55 and $60, the height of the consolidation range is $5. After the breakout, the target price would be the breakout point plus the consolidation range height, which would be $60 plus $5 equals $65.